some great questions we've gotten from the group in the first hour, and I've been asked to repeat the question, so I will be doing that in this next session. Whenever someone asks a question from the floor, I'll repeat it to make sure everyone hears. Some really good questions. Boy, somebody did ask about Pfizer and other companies too, and the question is, what about all of these share repurchases that companies are undertaking have in recent years? And many companies are borrowing, raising debt in order to buy back stock. Is that a good idea? I think the short answer is it's a good idea until it is overdone. It's like so many ideas in the world of finance. It starts out being a very good idea when your stock is way down. You buy back. It's even okay to borrow some money if you can borrow at a low interest rate to do it. But then when your stock has already moved up 40, 50% in 2 or 3 years, and you're still buying back and you're still borrowing money to do it, then it becomes a counterproductive thing. And so you want to watch out for companies that do that. You want to watch out for companies that keep buying back at the same rate as their share price goes higher and higher, because that ultimately it becomes counterproductive for the shareholders. So that's something to watch. During this session, we're going to be trying to get down to brass tacks, look at a couple of stocks and funds that can make it in practically any market. I've told you in the first session, I think we're in a pretty decent market environment with a gentle tailwind behind us, and shouldn't be a problem for the rest of this year. But there is always that caveat: someone can do something crazy. Somebody somewhere can press a button and do something crazy. And you want to own a good core of stocks and funds that will take care of you and at least not hurt you too badly in any environment. We had a nice talk with some lady last night at the cocktail hour who was telling us about how her stocks had been down about 25% in 2008. Well, that's a year when the market was down about 37%. And really, to be down 25 in a year like that was actually pretty good, because it meant she had a lot less ground to make up on the recovery, on the rebound. And I think I suggested to her, you really ought to go back and take a look at your statements from 2007, because I think you would find that your portfolio, because you didn't lose so much money in 2008, it probably has done a lot better than the market indexes since the top in 2007, because you spared yourself that problem. And that's what we're trying to do here, to find a few stocks that we can get into even now. If something goes wrong, we have rain instead of sun. I mean, here we are in Washington. We thought it was going to be sunny in the beginning of April here in Washington, didn't we? And not quite. Sometimes that's what happens. It rains instead of at the time when you think it was going to be sunny. That's why you need some investments that will take care of you in any market. What makes for these all-weather stocks? A couple of principles. And this is, I hope you'll take this stuff home, meditate on it, and try to put it to work in your own stock picking. I've said to many people, I'm trying to teach you how to do this on your own, not just I don't want to form an army of folks that are just going to walk right behind me and follow everything I say. I want you to learn how to do this yourself, so that you can question the advice I give, but even more than that, so that you can find some opportunities that I've never found. And your own research will turn up some opportunities that I've never found. And you'll get rich with those, okay, if you understand these principles. So what makes for an all-weather stock? First of all, an entrenched business franchise. A business franchise that can survive the ups and downs of the business cycle. There are lots of businesses out there that look superficially plausible and attractive. I'll give you one that I'm looking at right now. I find very tempting, but I'm just not sure. I'll give you a name of one. Ralph Lauren, okay? A lot of nice, I've worn some of his stuff too. It always looks well designed, and The stock looks cheap. Is it really an entrenched business franchise? I don't know. Maybe you have an answer to that. It's not an absolute answer, but I've seen an awful lot of designer clothes come and go. Is his brand an entrenched business franchise? So there's question. There's a good case in point that you can meditate on right now. What do you think of Ralph Lauren? Is that an entrenched business franchise? He has a healthy balance sheet. Share price isn't quite as low volatility as I might like. I think the management is trustworthy, but the thing that really bugs me is it possible for someone in the rag trade to have an entrenched business franchise? I'm not sure about the answer to that. Maybe you can tell me at some point during the conference what you think the answer to that is. But you want to be able to answer a definite yes. Entrenched business franchise, trustworthy management. I'm not saying they will never make mistakes, but will they level with you, not hide the problems and try to sugarcoat them and find all kinds of euphemistic ways of describing problems? Because every business faces problems periodically. I like managements that will actually tell me, look, we've had trouble, we understand the problem, here's what we're doing to fix it. Don't try to tell me it's not a problem. Admit that it is a problem, and what are you going to do to fix it? That's what I expect out of management, and managements that don't line their pockets with outrageous stock option programs and things. Stock options are legitimate within limits, but if the program is egregious, if the salaries are egregious, you don't want to deal with managements like that. Healthy balance sheet, modest debt, low volatility share price. How would you know whether it's a low volatility share price? There are various ways of measuring it. Beta is one that you will see listed on most quote sheets that you find for stocks. That's a pretty good measure. It's not infallible, though, because certain very volatile stocks, like gold shares, tend to have a low or even negative beta. So they would seem to be unrelated to the market, and they are unrelated to the rest of the market, but it's not because they're low volatility. They actually are very volatile. So the best measure that I've found of volatility is called standard deviation. And again, if you're a Fidelity customer and you get one of those reports, what did I call them? It was from Thomson Reuters. If you get a Thomson Reuters report on any company from Fidelity, they will tell you what the standard deviation of that stock is. And generally, I like to see stocks which have an annualized standard deviation of 30 or less. 30 or less. If you get them down around 20, those tend to be really conservative. The Johnson & Johnsons of the world will tend to be down around 20, maybe even a little below 20, okay? But 30 or less is what I like, a standard deviation of 30 or less over a 3-year period. That's a good measure of volatility, because the high volatility stuff is going to scare you. It will prevent you from sleeping, okay? So I had a question earlier from a younger man about how do I adjust my my portfolio to how do I adjust your advice to my own situation? And you can see that a lot of the companies that a younger person might be interested in would not necessarily, they might have an entrenched business franchise, but they wouldn't necessarily have a low volatility stock price. So a younger person might be able to accept, especially small companies, which will tend to have higher volatility share prices, maybe above 30. You know, you may have some room for those if you're under 40, let's say, under 40 years of age. Maybe you'll be willing to buy some smaller companies with the higher volatility share price. That is justifiable at an age where you can accept more risk. Okay, but most of the companies that are going to meet these qualifications 1 and 4 are going to be large cap companies. Smaller caps maybe for younger people or for people who have quite a bit of excess resources in their portfolio, and they can afford to take more risk. You go to the smaller caps. All right, now let's take a case in point among our entrenched franchises. One we've just recently added to the model portfolio, Wells Fargo, one of the nation's largest banks. It's been well vetted by somebody who is a pretty good investor, Warren Buffett. To me, it's significant not only that Warren Buffett owns a large position in Wells Fargo, but that he has been increasing his position recently, okay? He has increased it to 10% of the company, which is worth something like $24 billion. So he not only has owned a large position for a long time, but he's increasing his position in recent times, and I like that. I like to see someone who has good judgment, who is buying at the same time that I am. Okay, so that's a very strong point in favor of Wells Fargo. Now, what about some of the things we can tick off in terms of quality? Quality on the bargain counter. Boy, if I could summarize my whole philosophy in one line, that would be it. To buy Tiffany quality at Kmart or Walmart prices. We can't even say Kmart anymore, can we? Tiffany quality at Walmart prices. So the core bank, the Wells Fargo Bank, is rated AA-, which is very high. It's the highest in the U.S., shared by 4 others. So you've got a high-quality balance sheet. You have earnings that are coming. 47% of their revenues are coming from fees. Why is that important in today's world? Well, the interest rates are low, so they're not earning much on their loans, right? No bank is. No bank is earning much on loans nowadays. So a bank like Wells Fargo that has a large source of fee income is in a stronger position. Okay, so that goes to the entrenched franchise, the sustainable business model. They're earning nearly half of their revenues in the form of fees. They have a low-cost deposit base. Some of you folks may be Wells Fargo customers, or you may live in a region, especially California, where Wells has a large presence, large footprint, and you'll find they don't pay a lot on their deposits, do they? But that's, in this world, in today's low-interest world, that's the way a bank has to survive. And so they've got a lot of people who've got checking accounts there or savings accounts that, for whatever reason, those people are willing to accept rock-bottom interest rates. I wouldn't recommend it myself. I keep telling you, you should try to put some more of your money into these internet-based banks that are paying much more than Wells Fargo or any of the big commercial banks. But people don't listen to my advice for some reason. They still keep their money at Wells Fargo. So that is a positive for Wells' business model. They have a low-cost deposit base. Superior cost control. Interesting thing. You can have this even in a big business, a big, profitable, successful business. Just an appropriate focus on controlling costs. It doesn't mean that you cut out every single benefit to employees or anything like that. You still need to treat your employees well. But so many businesses, especially in the lead up to 2007, just let their costs get out of hand and have never been able to correct things unless they were forced to by bankruptcy. And it's a sad thing to see, really. It's, again, an inability to adjust themselves to the times. But Wells has done a good job with this. They've much better than other banks. They've cut out branches, for example, that were no longer productive. Close them down. You have to do that. It's not fun to do that, but you close them down if they're just not. They're not bringing in the business, and so they've been better at that than some other banks without mistreating their employees. It's a difficult balance, but they've done a good job with it. And it's not expensive. It's trading at about 11 times estimated 2016 earnings. Remember, we said that the S&P 500, the index that represents the market as a whole, is well over 16 times this year's estimated earnings. Wells is at 11. Now, is that a high price, low price relative to Wells' own history? It's about where the bank was before, in the 2004 to 2006 period, before the crisis really set in. So it's not rock bottom cheap, but it's reasonable, and that's all you're going to get today. You're not going to find a lot of high-quality franchises that are absolutely dirt cheap, but this one is a reasonable deal. It's paying a 3.2% yield as of Friday. So, that's decent. You can't be greedy. You can't be greedy in this market. So we're buying Wells Fargo in here, I think up to $27.50 is our price. I think you'll be very satisfied with. That's the kind of stock that in the decent market I'm talking about, if we have this decent tailwind behind us, this is a stock that could generate a total return of 15 to 20% very easily in the next year from here. Maybe even a little more than that. If the market's up 7 to 9, Wells could be up 15 to 20. And I would be happy with that. Yes, question. $47.50. Did I say something? Oh, I'm sorry, not $27.50. Golly, senior moment. Okay, see, I'm almost 65. $47.50. Thank you. Yeah, $27.50, you're not going to see it there unless there's a real crisis. Good. Now, here's one that I've talked about in a blog, but we haven't gotten around to buying it yet. I'm still hoping we can get it a little cheaper. It's come down some, but I'm hoping it will come a little cheaper. So this is a dream franchise. I really don't even have to give you much background on Disney, do I? I mean, you know what the Disney franchise is all about. That in itself tells you what a powerful company this is, because everybody knows about Disney. More people know about Disney than Wells Fargo. It's an American icon, and it's much more than Mickey Mouse. Besides the theme parks, you have the biggest sports network, ESPN. Now, right at the moment, that's a question mark in Wall Street's mind, because you have a lot of deals that come up for renegotiation. Sports programming is expensive. You know that Major League professional sports is a big business now with huge salaries, and so there's a lot of back and forth between the TV networks and the sports clubs, and of course the networks want to get the cheapest deal they can, and the clubs want to get the fattest deal they can, and so there's always this tension between them. It's not a slam dunk, so to speak, to use sports language. But if you have the right people in charge of a business like this, yes, there will be times when the street will worry: will this sports franchise or that sports franchise renew their contract with ESPN? But if you have good management over time, they're going to get more deals than they lose, and that's going to be a very important source of income, because sports is, let's face it, it's a major major pastime for Americans, and this is going to be around for a long time. I don't think ESPN is going anywhere. You have the Star Wars rights. You remember that in that 3-part series, they're planning now. They made a mint on the last one, the first one that came out at the end of last year. They've got two more of those, and I suspect it's going to be big. Star Wars is going to be big, and this will be income that comes in over the next few years. Then they have this rich library of Disney films and characters, and then all the paraphernalia that goes with that. Every new generation of kids seems to want it, and it's accessible through multiple platforms. So now 5-year-old kids have their handheld devices, and they're watching Disney stuff on that now. So it's if anything can be permanent in this life, I think Disney is it. Now, this is the interesting thing for me as an investor. Finally, the stocks come down to decent value. This, again, is one of those Thomson Reuters charts that I got from Fidelity. Free. You do have to pay your brokerage commissions at Fidelity. They're $7.95 a trade, but that's for a skinflint like me. That's not too bad. $7.95 a trade is not bad. If I drop an order in there now and again, like on a $20,000 or $30,000 transaction, what's $7.95? I can live with that, especially since they give me these free charts. So here we are with Disney. The forward PE, you can see that back in 2015, it was way up there, around 22 times. Now we're down more like 17. It's not as low as it was in 2011, so that's the caveat. If something goes badly wrong, there is some downside there. If something goes badly wrong in the overall economy, there is some downside. But is it a reasonable bet that should take care of us long run in pretty much any situation? Yeah, I think it is. And it's certainly a better bet than it was last summer. The people who were chasing it at the highs are regretting it now. Even though they own a great franchise, they're regretting it because they paid too much for it. Isn't that an interesting to think about, that it is possible to buy a very fine piece of in this case, of business, and pay too much for it. Just like it's possible to pay too much for a house, it may be possible to pay too much for a car. You have to look at all of these things and try to find the right price. And this one, I think, is a fair price right now, Disney. One thing to watch here is what happens with the succession in the executive suite. In the last few days, we've heard that Tom Staggs, who was kind of the guy, he's the chief operating officer at Disney and was second in line to succeed Bob Iger, the CEO. Tom is not going, he's leaving the company. He's leaving apparently because he was not promised by the board that he's going to be number one. This happens in big companies. The board wasn't sure they wanted to promise this to him just yet. He would have a couple of years yet to go, probably 2. Iger will be on there as CEO for another 2 years. That's what he said. Staggs wanted some commitment from the board that he was going to be it. He's in his early 50s. You can put yourself in those shoes, can't you? Early 50s, and saying, here's my chance to run a big company. Are you going to give me the commitment or not? And they wouldn't give him the commitment just yet. So he's leaving the company. You watch, he'll run something else that's very big. He'll run something big where they let him be number one right here and now. 52, I think that's 50. He's some early 50s. If I were in his shoes, I'd be very tempted to do the same thing. So we've got to see what they do here. It's important to find somebody with a good financial head who can also work with these difficult creative personalities that you run into especially in the movie making part of Disney. There's a long history of that. Go back to Wikipedia and read the history of the Disney company, and you could see they've had battles on and off for years with the creative people. If you know artists, you know what that's like. And I value them. We have some artists in our family, and they're the most precious people on earth. But often they're difficult personalities, and so they will need to find someone. Bob Iger has struck just the right balance. He's able to massage those sensitive egos, and yet at the same time maintain financial discipline. Can they find someone else with just that right chemistry who can deal with the creative people and still keep an eye on the bottom line? That's very important. So you want to watch for that. But if that stock came down, maybe I think we're looking at 92, 93. It's a little above that now, a few points above that. I'd love to buy some. We may have to raise our target a little. I would do that if I got some sign that they had a person in mind to replace Staggs who had that right mix of personality. That will be key for the next person to run Disney. All right, the cancer killer, Roche. Now this is one I want to tell you about because I have followed this company for years and years, and I've wanted to own it and never could until just very, very recently. It was always too expensive. Always too expensive. Based in Switzerland. Not too many people outside the healthcare industry know Roche. They're not a loud company. But I ran into a gentleman at a wedding reception some years ago. And this was at a time when many in the drug industry were having big problems, cutting dividends, and the research pipelines were just not producing, and it was a really tough time, 05 to 08 there in the drug industry. And I said, what's with you guys? What's your secret? And there is a secret. They have a secret. And this is, we could call it Swiss inventiveness and efficiency. That's just a headline. But the secret really is that Roche is willing to put more money into early stage R&D than most drug makers. The industry puts about 54% of its research budget into early stage R&D. Roche does about 60%. It amounts to a lot of money when you get into the millions and billions. And essentially what Roche is saying is we trust the people in our labs. We're going to let them work on some of these early stage compounds that might be a little different from what other people are working on. And sure enough, it has worked for them. They've had a very productive research staff for many, many years. And you constantly find that they are producing, for a company their size, they're very big, but for a company their size, they're producing more reports in the medical journals. They're bringing more products to the FDA relative to the size of the company than others are. So it pays off. This early stage research is paying off. They have biotech exposure through Genentech, which they bought a few years ago. The dividend is paid in Swiss francs. That's what CHF stands for. Confederatio Helvetica means Switzerland. Swiss francs has tripled in the past 10 years. Nice. I wish I owned more stocks that had tripled their dividends in the last 10 years, and perhaps even more important to me, increased that dividend 29 years in a row in Swiss francs. Why do I keep saying in Swiss francs? Would you rather own dollars or Swiss francs? Over the long run, you'd rather own Swiss francs if you're smart, because the Swiss have done a much better job of maintaining the purchasing power of their money. So yes, the dividend will be translated into dollars when you receive it, before you receive it, but initially it is paid in Swiss francs. And, if I can have a top quality company that's paying me dividends in Swiss francs and has a record of doing it for 29 years in a row, that deserves a place in my portfolio, yielding 3.3%. So that's, a decent yield too. They pay only once a year. I got an email from a subscriber who was a little upset about that, and he said, they only pay once a year. That means I'll have to wait till next April before I get anything. Okay, you'll have to budget so that, you can wait on that dividend till next year. Only once a year, but that's how the Swiss do it. 3.3% though. When that check comes, it'll be a big one. When you get that check, it'll be a big one. Now, this is interesting. Talk about valuation. Okay, here's a top quality company, and UBS, which is the big Swiss banking firm, has made an estimate, and I've seen the report and how they calculated it. I thought that very intriguing, that they have estimated that present value of Roche, that would be the fair value of the company, at 307 Swiss francs. Now, what's that stock selling for right now? I won't tell you the dollars. You want to know the Swiss francs. It's selling at 243.4 as of Friday. 243.4. UBS believes, and I've seen the estimate. It looks reasonable, and they're not using any crackpot inputs here. They're estimating that it's worth 307, which is an upside of 26%. Very few quality companies that I can point to have anywhere near that upside in today's market. I mean, if you know of one, please tell me, will you? Email me or stand up in the back of the room and scream. a company as high quality as Roche, with 26% upside from here, I don't think there are too many. I do not think there are too many. So yes, I'm buying Roche, and they have had this tremendous record in oncology, one blockbuster after another in the cancer field, and now they've I think they're going to do some great things in the years ahead with the new products they're bringing out. We've got I think we bought it at $30.50 or less. You could probably go up to 31, and you wouldn't be hurt. You really wouldn't. With that much upside, if it's got 26% upside, if UBS is anywhere near correct on this, you could probably pay a few cents more than the $30.50 that we recommended. But that's one. Yeah, I've been waiting years to buy this, and finally, it's at a reasonable price. Was it cheaper in 2011? Yeah. But we can't turn that clock back. So we're looking for things that are attractive now that should take care of us in today's market and won't hurt us. And I think Roche is one. By the way, you notice the ticker symbol down there? OTC, RHHBY. You can buy it through any broker. It's not difficult to do. There's good trading volume in it. But it's not listed on the New York Exchange. It's not even listed on NASDAQ. This is called the over-the-counter market. So you just key that number in, or those letters in, RHHBY, and you'll get a price that should be right around $31 now. They do not list on the New York Stock Exchange for the simple reason that the SEC has imposed lots of regulatory requirements on foreign companies, and many foreign companies just don't want to comply with the pile of reporting requirements. Roche is one, and that's one of many. Nestle is another from Switzerland. They do not list on the New York Stock Exchange for that reason. They don't want to have to file all the paperwork the SEC requires. But you can get any investment information you want on their website. It's all in good English. The Swiss speak very good English, or at least write very good English, and it's really kind of a thrilling thing to look at, to see what kind the diseases that these people are working on, and the successes they've had in conquering them, and the things they've got coming down the pipeline. It's an amazing company. I've bought a good chunk of it already for myself, and I'm hoping to buy some more. And I can wait till next April for that dividend. I have some other dividends coming in that'll take care of me in the meantime. All right. Now, let's pass on to all-weather mutual funds. We've talked about a couple of all-weather stocks. We got Wells Fargo, we had Disney and Roche, and now let's talk about what makes for an all-weather mutual fund. Many of the same characteristics. We want a sound investment strategy, and by that I mean not some cockamamie thing. Now, like years ago, I think this guy finally went out of business. But there was a mutual fund back in the crazy days of the internet, the era, the bubble, .com bubble, 1998, 99, and this mutual fund was based on the idea that people would just email their suggestions to the manager, and whoever sent the most, or whatever company was mentioned the most times, the manager was going to buy it. This is crazy. That's not an investment strategy. Just take as many. Whoever gets the most votes, we'll put it in the portfolio. That's crazy. No. You need an investment strategy that has proved itself over time, such as the idea of buying stocks when they are at a lower PE ratio than where they've been in the last 5 years. Over time, that has been proved, over decades, many decades, that's been proved as a good discipline. And actually, so that I'm not tooting my own horn only, I'd encourage you, especially the younger people in the audience, to go listen to Louis Navellier, because his momentum-based strategies have also paid off very well over time. It's a sound investment strategy. It has different risks and you must be aware of those when you engage in that type of investing. But it's a sound strategy. And there are a number of sound, dividend investing is a sound strategy, okay? There are a number of sound strategies. But you want to be sure you're in a fund that has a strategy that makes sense. You want a stable management team, not the revolving door. That is something to be worried about, especially nowadays. We see a lot of fund managers who will try to build up a good record, 3 or 5 years record, and then they'll want to leave the company and start their own shop because there's more. They'll be able to keep a bigger chunk of the revenues. So that is a phenomenon that can destabilize an investment company, even in a big, well-established investment company. We're on recorder, aren't we? Well, I'll mention the name. She can't do anything but sue me. Fidelity has a problem with this. I don't think they give their managers, there are exceptions here, but in many cases, I don't think they give their managers enough leeway to pick the stocks they really want. And as a result, you find that at Fidelity, with a few exceptions, the funds tend to gravitate around a few well-known names, and basically they're copycats. That's what I'm saying. They're copying each other. A couple of the managers there are a little more daring, and those tend to be the people with a lot of seniority, and so they can do what they want. But a lot of the younger managers there are just kind of copying each other, and I think that has hurt the stability of the teams, because when a younger manager does just copy someone else, he or she doesn't really compile a distinguished record. You look like everybody else, and so the person gets weeded out after a year or two. And so then they bring in someone else who does the same thing, just try to imitate the others. And that can be a problem in certain organizations. So you want a stable management team, people that have been around for a while, stay together. Reasonable operating costs. This is probably the most important thing of all. Each fund category has its own normal operating costs. An international fund is going to have higher costs, let's say, than a U.S. fund. A small cap fund will generally have higher costs than a large cap fund, but you want lower costs. Lower is better. I mean, anything above 1% for a domestic mutual fund is something you really need to look at very carefully. They'd better be really special if they're charging over 1% for a domestic mutual fund. Then a strong risk-adjusted track record. You can get this at Morningstar, free information. Go to the Morningstar website under risk, and they will tell you what the Sharpe ratio. That's usually the best indicator to look at. The so-called SHARPE, Sharpe with an E ratio. And a company or a fund that has a higher Sharpe ratio than its peers, a higher one than the S&P 500 index, is generally the kind of fund that you want to own. And then my own little fifth criterion here is the lower volatility than the market and the peers. You can get that, again, from Morningstar by clicking on the risk category under any fund you're looking at. Lower standard deviation than the market and the peers in that fund group. It's a funny thing, but over time, the funds that take a lot of risk and they go way up are also the ones that go way down. They look great while they're on the ascent, but when the market turns down, you give it all back. And not only do you give it back, but you know what it feels like to own those funds when they're on the down. It's you're pulling your hair out and wondering, what do I do now? So spare yourself that agony. Go with funds with lower volatility than the market and the peers. All right, here's a dividend champion. We've talked about the strategy of investing in dividends almost ad infinitum, so you know all about that. It is a good strategy. It's been proven over many, many years. And Vanguard has this wonderful exchange-traded fund with an ultra-low expense ratio, 9 cents a year per $100 invested. I don't know why. I had to shut down this newsletter and just put everything into Vanguard, the high dividend ETF. Sometimes I wonder, what am I doing? Why don't I just give it all to VYM? Why do I bother with all this? Well, I say that in jest, but maybe you ought to put a significant chunk of your change into that Vanguard fund and just let it ride. Remember, we were talking about just letting things ride. Well, a fund like this pays you good dividend. Sometimes the fund will be up higher. Sometimes it'll be lower. Reinvest your dividends and let it go. I mean, that's not a bad strategy for a good chunk of your wealth. It'll save you from many mistakes if you just get into something good like this and stay with it for a long, long time. 433 stocks. I can't follow 433 stocks, but they're in there. They're in there. You get wonderful diversification. You've got a 3% yield, over 3% yield. And then if you deal with Vanguard directly, you can also buy the open-end fund directly from Vanguard with no sales charge. With this ETF, of course, you can buy it through any broker, but you're going to have to pay the broker's commission to buy it. Now, that may not be much if you're dealing with a low-cost broker, but if you go directly to Vanguard, if you're a Vanguard customer, you won't have to pay any commissions at all to buy VHDYX, which is a clone of the dividend yield ETF. And here are all those Morningstar stats. I'm showing you this just so that you can see what I'm talking about here. Okay. You'll see this if you look under Risk, the Risk tab at Morningstar. Free, remember? Free, go to Morningstar. Free, it'll charge you nothing. Free. Got that? Free. 5-year trailing record. Vanguard has a standard deviation of 1042. The S&P is 1194, which is lower. Vanguard. Got it? Lower. The category is 1249, which is Vanguard, about 20% lower. Less fluctuation over the last 5 years, and yet look at return. Higher than the S&P and higher than the peers. That is miraculous. When you have a more stable share price, substantially more stable share price, and higher return than either the index, the S&P 500 index, or your competitors. Wow. That is a gem. That is a gem. More profit, less risk. Okay, that is a gem. Got it? Morningstar, free. Check all your funds that way. Okay, we mentioned that. Now, the last one I'm going to mention, then we have to throw it open to questions again, is the Vanguard Healthcare ETF. I think of all the defensive sectors within the market, we're looking now here at a narrow segment of the market, not just all the dividend payers. That's a big chunk of the market, the dividend payers. But now we're getting down to just the healthcare sector. I think healthcare is the most attractively priced of the defensive sectors of the market. Defensive being the industries that tend to hold up well even when the economy is bad. Even when the economy is bad, healthcare does okay. People still get sick, right? Even in bad times, maybe even more so. You have low overhead at this Vanguard ETF, 0.9%. You can hardly even read the number, it's so low. 345 stocks. I don't own 345 healthcare stocks. So you got wonderful diversification, all U.S.-based, and you have 24% in biotech. So we had some younger people saying, you know, should I be in? Yeah. You should have something in biotech. 24%, I think, is reasonable. It's, there is there's more risk here than in the Pfizer or the Roche, but if you're thinking about growth, especially you're under 40 or even under 50, you're thinking about growth. This is a nice balance where you're getting some biotech in there, but also you're in a defensive sector of the market. And right now, healthcare is more attractively priced than utilities even, okay, because it hasn't gone up as much. Again, I looked at the same ratios that we looked at previously from Morningstar. Lower volatility. This Vanguard fund has lower volatility than the typical health sector fund, higher return than the typical sector fund, higher Sharpe ratio than the typical sector fund. So if you're going to think healthcare, think Vanguard. It's as simple as that, okay? If you're going to go with healthcare, go with Vanguard. Great. So I think we've given you some all-weather funds and 3 all-weather stocks. And now we have to throw it out to your questions. We've got about 12 minutes for questions.
Thank you. Richard, on Roche, is their dividend, when it's paid to us here in our country, do they hold back anything? Can we have this in an IRA, or should we have this in a traditional account?
Yes, good one. Yes, there is a 15% Swiss withholding tax on your dividend. So you can, you want to hold that outside a retirement account, because in a retirement account, that withholding tax is lost forever. If you hold it in a taxable account, Roche, in a taxable account, then you can take a credit against that withholding tax on your US 1040, okay? There's also a small fee that the custodian deducts for translating the dividend from Swiss francs into US dollars, but that's a couple of bucks. But the main charge is for the Swiss withholding tax. Hold it in a taxable account so that you can take the credit on your 1040. Yeah, good. Another question somewhere? I think we have one down here in the front. Mary, thank you. And thank you, Joe, for coming. Joe, by the way, comes from California, and he's here almost every year. Isn't that amazing? I think we got to give this guy a hand.
Great presentation. I'm also from West Santa Fe, New Mexico. And
wonderful.
Relatively new to your newsletter. And I'm 70, and my philosophy is to stay in the equities, about 75% in equities, equally divided between health, food, and energy. Energy, I follow the XLE, I believe, ETF, and you mentioned a VHD for health. Do you have a suggestion for food?
Well, there is a sector ETF for the consumer staples. That's the closest to food that you can get. I don't know that there is one with just food companies in it. I would have to research that further. The question is whether there was a sector fund that just takes in the food companies. I'm going to be able to research that for you. Let me make a note on that. A food ETF. There is a consumer staples ETF, but I'm not sure whether there is a food ETF. In any event, I wouldn't be buying it right now because food stocks are high, really, really high. They're expensive. So I'd be much more interested in increasing my healthcare position now. Food later on. I mean, I love food stocks. I've done very well with food stocks over the years. And there will come a time to buy those. The time to buy them will be when the street is no longer interested in food stocks. But you will know in your heart of hearts, people will always eat. So if I can just get it a little more cheaply, then I would buy it. All right? But I will watch this. I will see what I can find for you if there's a pure food ETF. Another question was asked, and I will answer it at the end, but let's try to get some of these from the floor first.
Okay, thank you very much. Certainly enjoy your presentation. Disney and the impact of the theme parks over the years outside our country, like in Paris, seems to have been a negative. Now they just started up Shanghai just this past week. What about the impact of Shanghai, one, is their weather conducive to a Florida level of weather? I'm not sure. And its potential impact on Disney stock.
Yes. What about the impact on Disney of the theme park in Shanghai? Yes, they're working on one, and it's going to open very soon. I think it's costing in the billions to build, and my sense is that the Disney Shanghai, maybe not so much because of the climate. The climate, it will certainly be better than Euro Disney. Euro Disney has suffered from the beginning because of the northern European climate not being that great. So yes, I think there will be China will be better partly because of the weather, but more so because the Disney characters and the Disney aura is something new for the Chinese. And you have a rising middle class in China rather than the jaded middle class in Europe. And so you remember when Euro Disney opened, there were actually some protests from French people, the highbrow culture people in France who thought this was diluting our superior culture with these American stuff, But in China, there's none of that attitude. People are rising into the middle class. We'll talk a little about China in the next session, actually. But I think that's the most exciting thing. You're talking about what is the most exciting thing about China? We hear a lot of negative stuff about China, but the most exciting thing from the perspectives of someone looking out 5, 10, 15 years is the emergence of the middle class that will be spending money on entertainment and travel, the things that Westerners like to do, and I think the Shanghai Disney is going to be a big winner. Yes, much more so than Europe. Much more so than Europe. Why don't we take one last one, and then I have to answer the question that was put to me earlier before the session began.
I'm just wondering if you're familiar with any good aerospace stocks.
Good aerospace stocks. I would say at the moment the one that intrigues me the most would be Boeing. I'm not sure I'm ready to buy it just now, but it's on my watch list. And I would encourage you to do some of your own homework along the lines that I've suggested today. Look at some of these. Get your charts that will tell you where it stands in terms of valuation. I think you'll see that it's coming down and it's looking much more attractive than it was, and that would probably be at the top of my list right now. But it's not one that I'm jumping at. It's one that I'm watching. I told you I watched Roche for years.
Yeah.
Years, and then finally the price was right. I'm a very patient man. Very patient man. I'm willing to wait. Yes. We had one question before, so watch Boeing, BA, ticker symbol BA. We had a question before the session. Why do we have an incredible dividend machine in addition to our model portfolio? The answer to that is that I have the median age of my subscribers is about 58 and has been since the memory of man runneth not to the contrary. It's always about 57 or 58. What happens? I guess we bring young people in and we lose some on the other end. That must be what happens. It's always right about 58. It's like these old Russian churches during the Soviet Union. They always had these same little old ladies that were in the pews. So how could it be? Well, some younger women must have become little old ladies, and the other little old ladies went on to their reward. So we're always about 57 years of age at the median. And that means I've got a lot of folks that are already retired, have substantial portfolios, and need more diversification into dividend stocks than we can provide in just the few model portfolio stocks. So that's really what we're trying to do, give you some more. I talked to one lady that had over 100 stocks in her portfolio, and bless you, I think that's a wonderful thing. You get as long as you can remember why you bought each of them. Okay? Well, if you get to the point where you can't remember why you own these things, then you've got too many. But I'm a big believer in diversification, and so we're trying to give you more opportunities if you're in retirement to get some income, especially from some of these dividend machine stocks pay higher dividends than the ones we offer in the model portfolio. So it's really, to be honest with you, the dividend machine is for the retirees in the crowd. It's probably not for folks that are under 40. I wouldn't recommend that necessarily, unless you're super conservative, even more conservative than I was at age 40. Okay, it's for the retirees. So it's something extra. It's an extra. If you ever want me to throw it away, I will. But it's just something extra that I've done as a favor to the retired folks in our audience. Good. Let's take 15 minutes. We'll be back to hear about China, and that will be our last session before lunch.